Hello and welcome to the next in the series of economics podcasts for the Pigott School A-Level. Looking at market structures today. There are 4 different market structures. We're going to see only be able to get through the two smallest ones today, and then I'll do the 2 bigger ones some other time. So when we're talking about market structures, you're looking at individual industries and how they're formed, how they're structured. So that would be things like how many firms are in that particular market, how the products or services might or might not be differentiated, are there any barriers to entry or exit, are these firms efficient, do they have market power, so high market share, elasticity, inelasticity, and will they make normal or abnormal profits. So they're the things you're looking at when we're looking at market structures. The big ones really are the number of firms, are there barriers to entry, and are you going to make supernormal profit? They're really the big ones. So the smallest one of these, or what might be called sort of the holy grail for economists because it is the most efficient, is perfect competition. So in perfect competition, it doesn't really exist in the real world. It's very difficult to find examples of. We've got things close to it, which I'll go to later, but it is it's a model to compare to. So perfect competition is something we would like industries to be. So in perfect competition, you have lots and lots of firms, so hundreds of thousands, millions across the globe. The product is not differentiated, so it's what is called homogeneous. So the products are identical. There are no barriers to entry or exit, so you can come into the industry at ease with no costs, and you can leave the industry at ease with no costs. It is the only market structure that is efficient. It is both productively and allocatively efficient, so where marginal cost equals average cost for productive efficiency, and where marginal cost equals average revenue or price or demand for allocative efficiency. They only make normal profit, so they can't make any abnormal profit because of one of the previous criteria, that if they were making abnormal profit, then because there are no barriers to entry, other firms would come in and take that profit. So therefore they have no market power. Each individual firm has no market power. They've got no power over the price, no price setting power. The demand for the product is perfectly elastic. So each individual firm in that industry would make up all of these individual firms would make up the market demand curve. Now, when you get to the diagrams for perfect competition, you will notice that the average revenue and marginal revenue curve is completely flat. So they're equal. So it's a completely flat line. That is because, as previously said, they have no market power. The demand for the products or services is perfectly elastic. If any individual firm in the market tried to raise the price, a key feature I've missed out there, just stumbled back upon, is there's also perfect information. So every firm and all the customers know everything about all the prices. There is perfect information across industries. So because of that, and this perfectly elastic demand average revenue curve, if any individual firm tried to raise their price, the consumers would be aware of this, the other competitors would be aware of this and keep their price the same, and everyone would switch to another firm. Why would you continue? There's no market power, there's no branding, all the products are homogeneous, they can't differentiate them. If there's a higher price, all of your customers will leave. So you're stuck at this price, at this perfectly elastic price. Now, if you lowered price, you might think, well, wouldn't I then steal everyone else's customers? But everyone else would follow. So there's perfect information. If you lowered your price, every other firm in the industry would lower their price as well. So there's no incentive to lower your price. The marginal cost and average cost curve. So the average cost curve sort of looks like a smiley face, like on your economies of scale diagram. Because you're only making normal profit, that must be touching your straight line curve, your average revenue curve, and then the marginal cost curve will go through the bottom. So at that point, sort of a magical point in perfect competition, the marginal cost curve, the average cost curve, the marginal revenue and average revenue curve is the same flat line. We assume firms in perfect competition are profit maximising, therefore they all equal at this one point. So MC, AC, AR and MR all equal at this one point. So it's the only market structure where all of those curves meet at one point. So they're profit maximising but only making normal profit, because if they're making anything above normal profit, other firms would come in to take it away. But they are also productively and allocatively efficient at that point. All of this is in the long run. So I went through a couple of podcasts ago about what the long run means. All of this is in the long run. In the short run, it is possible to earn abnormal profit, but this would, for reasons I've said, be instantly eaten away because other firms would see this profit being made, no barriers to entry, they would enter the industry. So in the short run, you might be able to make abnormal or supernormal profit, but in the long run, that would basically instantly be eaten away. Perfect competition, as I previously said, it is a marker or a benchmark for economists. It doesn't really exist in the real world. Things like price comparison websites have helped with perfect information. So if you think previously you might have had to walk around different stores and compare prices, sort of totting them up. So now price comparison sites have helped with this perfect information. But you've got to think also behavioural economics wise, asymmetric information wise. Consumers aren't always really rational. They probably won't be going around and doing these things. Bounded rationality means they'll probably only look at a certain amount of information anyway. So whilst perfect comparison websites have helped with perfect information to a point, we're still obviously not at a point where we have perfect information. In terms of example industries, you could say to a point agriculture that products are sort of homogenous. Obviously you get different quality, you get different organic, but largely, a carrot is a carrot. There are hundreds, thousands of firms across or farmers across the world, meaning there are lots of firms, but there are barriers to entry. Obviously you need to buy the equipment. There is probably a little bit of abnormal profit, and even some individual firms might have a bit of market power, especially within countries. Currency exchange also used to be maybe an example, but again it only fills some of the criteria. Perfect information is a bit easier with the internet and looking at it, or going to the airports and seeing different boards. The product is definitely homogenous, so pound sterling is pound sterling. But even then, you're beginning to get a few bigger firms dominating that market. There is abnormal profit to be made. On a more smaller level, you might say things like car boot sales. They might largely be selling the same products, so the same CDs, the same books. There are very few barriers to entry, paying a £10 to sort of pitch up. They haven't got any market power. They might be making a little bit of abnormal profit, and there'll be lots of firms or boots of cars, depending on how many people turn up. So whilst there aren't any sort of concrete, definite examples of perfect competition, there are a few that might help you get your head around it. The next one along in terms of how big the firms are is monopolistic competition. Don't get it confused with monopoly. Monopolistic competition is where it's very similar to perfect competition. There are lots of firms, but not as many as in perfect competition. There are few barriers to entry, so it's not like perfect competition where there are no barriers to entry, but there are a few barriers to entry, but these barriers would be low. They aren't quite efficient, either productively or allocatively. They are likely to only be making normal profit, so the same as perfect competition. And here's the difference: they have a slightly differentiated product, so therefore they have some market power. That's the big difference. So instead of having a flat average revenue and marginal revenue curve where the demand is perfectly elastic, because they are able to differentiate their products to some degree, this gives them a little bit of market power, which enables them to have a slightly inelastic demand, which therefore will enable them to charge a slightly higher price. So this does introduce some degree of competition into the market. The best examples here are probably things like local hairdressers and Chinese restaurants. So if we go through the criteria, if you think of local sort of Chinese takeaway restaurants near you, there aren't really any national brand leaders. So there are lots and lots of different local ones that you could probably barely name unless you repeat custom there because of your sort of behavioural economics quirks. The barriers to entry are pretty low. Open up a shop, so you've got the rent for that. Depending on how good they are, they might be able to make some profit, and their market power will really come from the differentiation. So it will be a reputation for quality or a reputation for price, or simple things like offering free prawn crackers with every £10 spent. But you are able, despite the fact essentially a Chinese takeaway is a Chinese takeaway, you are able to differentiate slightly, which will enable you to look at the prices differently. And again, things like Just Eat, the Just Eat app has enabled us to help us with perfect knowledge. So you're able to look at, if you want a particular dish from a Chinese restaurant, you can then go to your Just Eat app. You don't have to hunt down menus. You can go to the app and check the prices. You can also check the differentiation of the product. Does it do the exact product I want? Is the price any different? So it's helped there with perfect information. And you'll notice if you go onto the Just Eat app and look at next time you're on buying your favourite Chinese, check the prices. Look, some of them will be charging slightly more than their neighbour, than their rival, for probably pretty much the same product. In terms of the diagram, this means the average revenue curve is downward sloping, and the marginal revenue curve is also downward sloping. The marginal revenue curve obviously must be downward sloping to make the average revenue curve slope downwards. They're only making normal profit, so your average revenue curve, which sort of looks like your smiley face, that needs to be touching your average cost curve. Needs to be touching your average revenue curve. So you've got a downward sloping average revenue curve, and then your average cost curve, the smiley face, needs to be touching the average revenue curve, and then the marginal cost curve must be going through the bottom point of your average cost curve. It's a bit of a tricky one to draw, but I would advise for that one, draw on the marginal revenue and average revenue curves first. Then I would draw on your smiley face average cost curve touching the average revenue curve, and then make sure that your marginal cost curve is going through the bottom point of your average cost curve, so that the points are equal, so that you are showing AR equals AC and only normal profit is being made. Okay, so they are your two smallest market structures: perfect competition and monopolistic competition, or it might be called contestable market, but it's the same thing, and don't get it mixed up with monopoly, which we'll do next time. The big difference is that in monopolistic competition there is a little bit of market power which comes from a differentiation of the product or service, whereas in perfect competition we've got lots of firms. There is no differentiation, the product is homogeneous, no barriers to entry. The only market structure that is in any way efficient is perfect competition. They make no abnormal profit, there is perfect knowledge, and they have no market power. So that's perfect competition and monopolistic competition.